thank you all. Thank you all for joining us. Well, it is certainly an exciting time in the market. We had our last webinar in early April as things were a little bit tumultuous, and we've sort of on hopefully the other side of crazy April, and things are a little bit more settled, but it is still a very volatile market. And with so much uncertainty, it certainly does come with some opportunities, but it also comes with some confusion. And so with all of that changing and moving around in terms of what the rate volatility is, what liquidity presents, what the market demand is looking like, it is also creating, a little bit of change in borrower appetite, change in some of the, product profiles and opportunities. And I think this is actually presenting a great opportunity in the market for how we navigate some of these expanded products. To that end, I'm really excited to introduce our panelists today. So from ARC Home, we have CEO Brian Devlin. Thank you for joining us. He is the president and CEO of ARC. He joined ARC in 2023, brings over 20 years of industry experience in capital markets and product development. And more importantly, ARC has been a customer of LoanNEX's for, I'm going to guess about 5 years, and we really appreciate you joining us and bringing your insights.
Thank you, Eloise.
We are also very excited to present Eileen Lindblom from NQM. She is Senior Director of NQM Funding. We appreciate, and I know that Rudy was originally marketed to be on. He had a conflict, and so we're very excited to have Eileen join us. She brings, again, over 30 years experience in the mortgage industry with a focus on securitization, capital markets, product expansion. Eileen was formerly with Flagstar, and we have worked with Eileen in her prior role and in this role for quite some time. So Eileen, thank you so much for joining us.
Thanks, Eloise. Glad to be here.
And last but not least, Robert Trahan, who's with LoanNEX. He has been with LoanNEX for a couple of months, but has worked with us for many, many years. He is Senior Vice President of Sales and Support and brings over 32 years of leadership in the mortgage industry, and almost all of that in the non-agency space. So thank you, Robert, for joining us.
Of course, glad to be here.
So we're going to do this very much as a roundtable style of talking about the market, opportunities, and ways to navigate through it. But I do want to say we'd love for this to be interactive. So if anybody has questions, please throw them up in the chat. We'll be watching out for those, and we can answer them as we go. So I'll start with can everybody see my screen? Is it showing? Oh, good. So we did our introductions. We are going to be talking about the trends that are going on in the market today. And also, throughout talking about what we expect to go on for the rest of the year and what's going on, coming up. But really, a lot of what this is all about is to talk about what's going on in the market, how people are able to grow their volumes with non-agency and get some best practices and tips. So that's what we're going to be covering. So with that, I'm going to, quickly open it up to what some of the rate environment is. The left side of the chart is really the MBA forecasts. We show this every time. There's really been a little bit of change in that the MBA's actually increased total origination slightly over their prior forecast, and most of that was in the refi side. So I guess that's reflecting some of the expectations of refi activity as rates are volatile. I know people are very opportunistic with refi activity, and that actually increased refi activity to 41% growth for refis in 2025, but overall 16% growth for the year. On top of that, we're also seeing a continued increase in demand for second lien volume. It's harder to project that, but with the right side of this chart is really showing you that the majority of loans are really not in interest rate zone to be refinanceable. So that results in a lot of people navigating to second lien products to structure their loans, to access liquidity in their homes and so forth. So I'm going to sort of quickly open it up. Maybe Brian, I start with you. And this is the MBA's forecast for 2025 and 26. How do you see the market shaping up? Are you seeing that same sort of growth in refi activity as well as, just sort of total purchase growth?
Yeah, and I think it's taken a few by surprise, right? I think most on this call and probably on this panel that would think that by the time we hit May of 25, we'd probably be, I don't know, given where rates are right now, 450 tens, that we'd probably be somewhere 100 basis points lower on just, let's say, kind of base treasury rates. And with all the volatility that we've seen and still inflation concerns and still a strong employment situation, it really hasn't progressed as many had thought, kind of the post-COVID time period. That said, the fact that there is life in that refi market, as well as in that second lien market, does show that, right, first it shows, home prices are still sticky, HPA isn't really going anywhere. If anything, it's increasing or flatlining, which is just a positive sign for housing in general, outside of supply. In addition, it just shows, how healthy this market is, as far as, the ability to get refis done, the liquidity that exists, the fact that, and where I was going with it, what it really shows is the fact that borrowers are accessing the equity in their house, right? As the turmoil that we're seeing in this macro environment, whether it's tariff related, new policies coming out of Washington, just geopolitical events, things of that nature, inflation, the fact that home prices, properties have not been impacted, and the ability for those borrowers to access that cash through that equity, I find is a positive sign. So I think all these things, given where rates are, that we're seeing this refi activity, we're seeing this in home equity at these rate levels, only proves the point that things will only get better. As we, my gut's telling me, right, that we're kind of probably at the higher end of this rate environment for the short term. And as as those rates come down, you're going to see that activity continue to increase.
Yeah, and we actually saw in the MBA forecast that they brought their projections for the 30-year up, so they had it slightly declining and they brought it up. So I'm just going to flip to what the yield curve has been doing. And I mean, these charts to me are just stunning as you think about, they are snapshots in time. And we, have on here, sort of mid-February, and then the red is where we were at the beginning of April. The green is where we were at the end of April. So those interim, sort of the shorter term treasuries really dropped, but we saw an increase in that 30-year. So there's just a lot of volatility in that, in that yield curve, and a lot of movement from the beginning of April. And then now we're up, up here in the purple with longer term rates increasing and still a decline over where we were. We're sort of almost in a flatter yield curve in February, and now there's that shorter term rates have really dipped quite a bit, but the longer term rates are still high. The right side of the page, which is what I'm going to get you guys to talk about, is really what these are LoanNEX index rates for different types of loans. So the black represents the 30-year agency. The gold represents what we call gold full doc, which is just the average across all of the correspondent investors on the platform for their full doc products, and a fairly, right down the middle, 65% loan to value, 740 FICO kinds of profile. The green is very similar to that, but DSCR. And we saw those rates converge, sort of in the middle of last year, and they've stayed converged. That's really showing the liquidity for those DSCR products. And then the silver above that is really just opening the credit box up a little bit, still full doc, but trying to give a little bit of an apples to apples so that we can see some of those spreads. But what we saw, obviously, in the beginning of April was those rates spike with all the turmoil that was going on with tariffs and so forth. And while the agency rates have come down a little bit over those past 4 weeks, we saw, a more exaggerated spike, obviously, in the non-agency space, which is not surprising, but it has been coming down. So now there's about a 40 basis point spread between the gold and the agency. And there continues to be about a 75 basis point spread, or actually more like an 80 basis point spread between the gold and the silver. So that's showing to me that, there is a wider spread, but it had narrowed so much. It used to be about a point spread, then it narrowed to about 50 basis points, then it narrowed to about 25, and now we're at about 40. So, Eileen, I don't know if, this is something that you're tracking, but could you tell me a little bit about how you guys think about where rates are for, for the non-agency side for your products? Do you see those as continuing to widen, or they're tracking nicely to agency? Or tell me a little about what you guys are expecting.
We're expecting kind of a continued tightening. The last couple of months, the market's been obviously skittish for all the reasons that have been discussed. But we're closely watching securitization spreads because obviously it affects the appetite for the investors to purchase the non-QM loans and, the ultimate execution and where they're going to pay. So, which obviously backs into how we're, going to price our loans on the origination end. So it's really hard to tell if it's going to continue this way, but the last couple of prints really in the month of May have started to come in tighter. I think the other investors, as far as the the large insurance companies, the appetite has remained steady, but they've started to change some of their criteria as far as what they'll buy. I think one of the biggest things that people are watching that tends to kind of reflect risk a little bit more is the short-term rental market. So, while we talk holistically about the spreads, there is certain cohorts of products that investors are taking a harder look at and, trying to, kind of distance themselves from a pricing standpoint. And that's probably the biggest one. I would agree with Brian, even going back to the last conversation. I mean, we're definitely seeing an uptick of refis, particularly on the cash out side. Versus, the rate and term is often kind of a life event at this point, as opposed to somebody wanting to rate and term out of what they have. But our biggest percentage of the refis is really cash out.
Yeah. So I'm curious too, Brian, if you want to talk about, the credit box, or, how you're seeing, we're seeing pricing obviously widen more, as you go out the credit box, but I don't know that we are seeing people shrink the credit box. I think they're doing it more with pricing, but I'm curious to get your thoughts on that as well.
No, I would agree, right? I mean, our job's to price this credit. And I think at times, to be honest with you, it was probably priced too tight, to be quite honest, right? I mean, if you look at, I'm looking at these charts right now, and and I think the reason you have this non-agency market and really this non-QM market is to kind of, bifurcate away from that agency market. And that investor needs that yield to go away from that guarantee, right? And at times, even during COVID, you would see, and even within the last 6 months, non-QM rates kind of trading on top of agency rates at times, right? And to be honest with you, if I'm an investor, that doesn't do anything, right? Just the liquidity, things like that. Selling a non-QM pool, doing a non-QM securitization takes a little bit of time. I'm an old agency guy, right? If you want to trade a TBA, you want to trade a pool, you could deliver that into a screen, right? Like in 3 seconds. So that investor does need that yield, right? The fact, though, that they're still so tight and means really just shows how good that credit is. And what it really shows is the money that has been allocated to non-agency investing, right? So, you know,
Yeah.
Eileen had mentioned insurance companies. I mean, the amount of, right? I mean, when I first started doing non-QM loans at an originator, right, it was, you know, it was a small subset of this investor class, whether it was money managers, hedge funds, securitizers, things of that nature. Now it's large insurance companies, large money-centered banks. Everyone's getting involved, which is just increasing that liquidity. The warehouse financing right now for this is uber aggressive from an advance rate scenario, from an interest rate scenario, right? Which just means that this market has been tested. We have enough historics on it that these investors, these bankers are comfortable with it. And it sustains, right? Like, you know, for how long this market's been around, it's been shocked a lot of times, whether you're going back to COVID, whether you're going back to the large duration solve we saw in the first quarter of 22, whether seeing even the stuff we saw in April, like liquidity hasn't gone anywhere. These spreads, this is just investors. Investors are going, I don't really care at 160 AAA spreads or 140 AAA spreads. I'll go buy, either I'll sit on my hands or I'll go buy a low ball agency pool for someone and get the same yield, right? Like, so the fact that that's what drives these, that's what you're seeing these blips on these charts. That's all that is. And I get it. If I'm sitting on an insurance portfolio, I'm sitting at, you know, a Wall Street broker dealer bidding these pools, I'm like, well, I'm not going to overpay for this at times. Now, to Eileen's point, we have seen in May these prints start to tighten. And all that does is, and I mean, I'm an old mortgage trader, right? I said on like, your next trade is really, everything's based off the last trade. If things start to tighten, people get comfortable with it, right? They're not going to overpay for things. That said, like, you could, even in the times of April, you were able to trade things. There wasn't people, you know, saying I'm not bidding it, where we have seen that in previous years and previous times. It's just, hey, this is where I care at the moment, right? And then a lot of things did not trade. Guys pulled it back. If guys were able to keep on a balance sheet, had that warehouse financing, things of that nature, they had the ability to kind of move with the market. And if you waited a couple of weeks, you probably, I don't know, 15, 20 basis points in spread on a couple of weeks. So this doesn't really scare me. This is just, you know, not agency market. It's going to be the first to react because you don't have Fannie and Freddie, you don't have Ginnie Mae, you don't have TBA screens, right? It's not as, I want to say it's not as liquid. You just don't have as many price points like you do in the agency market. I could pull up a TradeWeb screen and see what, you know, Fannie Sixes are doing every 3 seconds. Securitizations, right? I mean, you only do a few a month, right? Or so this type of things is not concerning, and it's probably healthy. The fact that we're starting to tighten and liquidity is still there, it continues to show really how deep this non-QM market is.
Yeah.
And then if I could just add one thing too, Eloise, as the agency and the non-agency spreads are tighter, it actually, so what I call the northwest corner of our LLPA grid, you know, the competition for that higher FICO, low LTV, while we love that credit, it's too on top of, you know, the agency pricing, and it's not appealing to investors. So a lot of times we get the question, well, can't we improve the LLPAs there? Well, no, because that's not appealing to the secondary market. So does that customer belong there? Well, definitely there's buyers that want that, but in a broad spectrum, it's not really where the investors want to play.
I love that. And there's so many great themes that are coming through, and I'm going to play off of them. The data is going to show us a lot of what you're talking about as well. But we did see a pretty, you know, significant shift in April, but what really was a bigger shift in the first quarter. So we saw a lot of volume in the first quarter, but that volume was a little bit different than what we had seen historically. And that was, you know, we saw the average loan size pop. And I think a lot of this was relating to, you know, jumbo refi activity because rates had declined a little bit. That was an opportunistic refis. And also in the purchase side, we saw some jumbo activity. Maybe people were sitting on the sidelines waiting and took a chance to navigate there. But we saw that that pop in the refi activity, but we saw a big pop in full doc. It just in terms of mix of loans in the first quarter. In the second quarter, with rates, then moving around, with so much volatility, the volume came down a little bit. Just people are like, let's hold off a little bit and see how this all settles. But it sort of settled back to what we've seen as historical mix, where full doc's about 17-18% of the total, bank statements in the low 20s. And DSCR picked up a little bit. It's normally right around 49.50, and we saw it up to 51%. And Eileen, I think a lot of that was because of what you just said. There was a lot of cash out refi going on those investment properties. And I think some of that was pent up. So that's maybe why the mix was a little bit different in April. But talk to me a little bit about, this is client demand. What I want to make sure I give a full perspective on these numbers that we showed to the right. These are all the loans. So this is, 40,000 loan scenarios, which equates to, I don't know, about about $30 billion of loan activity that has priced through LoanNEX. That's not all. This won't represent block activity. This is what's getting priced, So LoanNEX will typically over-index on DSCR than probably what you guys are actually locking. I'm going to guess you're in that 30 to 40% of your volume kind of range. But that's because those are harder to price. So people rely a lot more on LoanNEX to price those loans. But tell me, Eileen, I'll start with you, and then Brian, I'd love to hear from you. Tell me a little bit about what you're seeing in terms of income doc type trends, what people are looking for, what the market is looking like now. Because a lot of the folks that are on the phone are either starting this or they're trying to understand how do they best navigate for their borrowers, market, navigate, succeed in this part of the market.
So other than full doc, which does remain consistent, there's, bank statement loans are very popular and continues to increase as people become aware that that's an alternative to the, to the typical market. So we have a huge percentage of bank statement loans that come through. The biggest thing that any investor can do for their clients is to have that bank statement analysis process available to them. Otherwise, it's very hard for somebody to kind of navigate. It's something that I appreciate having at my new company versus my old company. So that helps that increase of the bank statement production come in. And while it's been around for quite some time, I think it's still new to a lot of people, and they're, kind of getting versed with it. But the typical loan officer who's been out there in the agency world, who might start to mix and kind of maybe start to dabble more in the non-QM market, will always kind of navigate to the full doc. And so we see that consistently there. But as they become aware, you see the bank statement product being the biggest. We have other alt doc types using like full doc rental income, but it's really going to go with the alt doc income. So you have bank statements, and then you start getting into the DSCR market where, obviously that's, like you said, about 30% of our business and probably overall. But I think that, the basic non-QM product is going to be your 30-year fixed full doc loan, about 50%, and then maybe 30-40% of the rest of it is bank statement. And then the other piece is, various and sundry others.
Brian, I'd love to get your thoughts as well. You may have, the same kind of mix or a different mix.
No, I mean, yeah, I think we're very similar, and I don't know if I have a ton more. I think Eileen covered it, right? And I think some of where you were going and I think where maybe I'm jumping the gun on this a little bit, but for the participants on this call, I do think, even outside of, let's just say, expansion of of credit, expansion of these guides, whatever, expansion of this product mix. It's really an expansion into the industry, right? And I still think this non-QM market is still kind of heavy on the coast, South, Florida, things like that. And it really still hasn't scratched the surface in other MSAs across the country. And to be honest with you, I think a lot of it's education, right? And I think it's important for, companies like ARC, NQM, that, experts in this industry to kind of lead that charge. And a lot of it's education down to the broker level, down to the lender level, and really down to, really realtors, right? So I think some are still confused of what borrower fits this product, right? And Eileen hit on the head. I think we're all agency people, but let's be real, right? Like for the most part, or I would say we're more all QM people, because for the most part, this market hasn't existed that long, right? And a lot of people are they were comfortable doing agency loans or full doc loans or, prime jumbo loans. And at times when in a low rate environment, yeah, you can earn money doing that and keep the lights on and be profitable. Times like this, it's important to branch out into these type of products, right? They're they're less rate sensitive. I mean, DSCR for general. I mean, look at that pop in 25. A lot of that is those DSCR borrowers aren't as rate sensitive as someone purchased the first home, things like that. So it's a stickier business in times like this. And to be honest with you, I only look at this non-agency market, and I know that's a broad term, right? It can mean prime jumbo, it can mean non-QM, just continuing to expand, right? As I think this administration in its first go at it wanted more private money into this industry. I think there's a lot out there that want more private money coming in outside of the GSEs, right? And I think non-QM has this, in a way, sometimes a negative connotation, but at the end of the day, it's an alternative underwrite to what we've been experienced in for majority of our careers, right? And I think it just will continue to expand. So
I want to, Brian, when you said it's an alternative underwrite, I want to hang on that for 1 second, because not only is it an alternative underwrite, but what we're seeing is in certain pockets, sometimes it's also more efficient than what the agency options are. And so I think that's really important, because a lot of the retail clients that we're talking to are sort of starting to get into this. They're putting their toe in, they're getting a little bit more aggressive with it, but you need to understand that giving people access to a broader spectrum of options sometimes is an alternative underwrite. And sometimes, like with high balance, agency loans, it may be more efficient, or with second homes and things like that. So, and Robert, what you're talking with a lot of the retail folks, what are you, hearing people talk about as they relate to getting into this?
So we're seeing a lot of kind of comfortability with the product, the credit box per se on non-agency, specifically with the lower LTVs, the weighted average FICO scores, mimic agency and prime jumbo, right? So from a credit performance perspective, the default rates are right on top of agency, a few basis points delta, right? Compared to FHA defaults and Ginnie defaults, right? So we're seeing a flight to quality in terms of originations around the non-agency space. We're also seeing at least feedback where instead of dipping their toe in the water and starting brokering out first, people are quickly moving to non-del as a driver for the extra margin and the brand protection, right? And then very quickly after that, they're talking about creating their own guidelines and putting out to bid, on mini tapes or larger tapes, multiple tapes on a given month, as their level of originator knowledge, it becomes baked. So their loan officer are more comfortable. They understand the ability to have outlets for these type of loans to better serve their borrowers. And then they use, obviously, as a pitch for LoanNEX, using our platform to help them more easily discover and find eligible takeouts. So are you seeing that on, actually, question to both of you, are you seeing more increase in the delegated or the shift from non-del to delegated? And how quickly are they really jumping into that space from your clients?
A lot of growth from the broker to the non-del to the del. A lot of people, like you said, are starting, who were broker, a year ago, moved to non-del, and then they develop their guidelines as they get more comfortable, and all of a sudden they want to do del and they want us to approve their guidelines. Which, I'm seeing the influence of that. My team actually does the underwriting guideline reviews, and we have, we're getting 20 of them a month. Like they're out there, and sometimes they kind of, obviously match exactly, and sometimes they don't, but definitely seeing an increase from one category to the other. But one of the things too that they need to be able to do, in addition to just having the underwriting guidelines and knowing the product, is having the constant liquidity and having the capital behind them to deal with, because you've grown up from a broker to a del non-del, and now you're signing an MLPA with EPD and EPO and repurchase obligations. So that part is a factor that I think people need to understand, that we look at those on a regular basis, and certain cohorts, while the delinquencies are very low in this market, there are certain cohorts that are increasing. So it's you really need to balance what's right for your business and what direction you should be going. And then, if you're going to be selling on a flow basis versus on a mini bulk or bulk basis, you need to be able to have the wherewithal to take that market risk as well. So
Sure.
it's, it can be a little bit, maybe too aggressive for some and appropriate for others.
And Brian, what are you seeing?
No, I mean, I would agree. I mean, this is just the evolution, maturity of this market, right? Everyone kind of dips their toes in, right? It is scary in the beginning. And as someone who rolled this out years ago at a large retail lender, right? It was kind of, you go in, you partner with a couple guys on a flow basis, you best efforts it. And, a lot of these large lenders, they don't have, really the capital constraints, right? Whether it's, unfortunately having to maybe buy back a loan, or really, right? Kind of the haircuts that are associated with financing these loans, which are higher than an agency loan, right? So there is that capital treatment, and then it really gets down to math of, all right, what's the pickup on that margin versus the risks that are coming with this. So I think everyone should be in this market. It's just at what level, right? Right, and I think it's something as you get more and more comfortable with it, right? And I think there's companies that exist like NQM, like our counterparts, that we're here for a reason. We're going to take that spread risk on. We're going to take that duration risk on, right? Hedging these things, as someone who used to hedge these things, it's not easy. You don't have a TBA market. You don't have that. You can be perfect on hedging that duration. You can't hedge that spread risk. So the chart you saw in April, that jump, you can't hedge that. Right? You can't hedge that with with swaps or treasury futures or whatever. You can hedge that duration. You can't hedge that spread risk. So that's why, non-del guys are getting that additional margin that they're being charged, because, that company, NQM ARC, we're taking that risk on. So it really gets down to it. And I've seen it 100 times, right? You have a couple good months, and then the market blows up, and guys going, uh-oh, what are we doing? And they pull back. So you just have to get comfortable with it. I think from a guideline perspective, I mean, I think most are pretty close to one another. I think the guide aspect of it is probably, some of the easier parts. It's just, what's your risk appetite? What is your C-suite? What's their risk appetite? Are they comfortable with it? And then it gets down to economics. What's the risk reward of, going non-del to del from broker and things of that nature. But to your original question, yeah, this is just this market maturing, which is great, right? It's as more and more people are getting comfortable with it, it's only going to continue to expand from here.
So as people are coming in, one of the things I want to make sure everybody's hearing is this is a different part of the market. It may take different tools. You may be going into the non-del side, the warehousing side may look different. That's the profit side of the house that is super important. Once you get there, then it's really about you're either in, but putting your toe in versus jumping in are a little bit different. And when we were, talking, when Rudy was talking with us on the prep, one of the things he was sort of, fairly emphatically pounding the table on, which he's not here, so I'll pound the table for him and let you guys respond, is you're not going to be successful in this with a toe in. You have to understand this is about serving the whole market. It was just frankly a big, we're a big advocate of it as well. The borrowers are changing. The market is changing. What people need is more than just agency products. And it's okay. It doesn't have to be scary. Brian, you just recapped a lot of the business side of it, which is super important. But there are solutions. You can come in on a non-del basis so that you don't have to absorb all of the hedging and all of the balance sheet side of it. It's a much easier way to get in. And as you get, more established with it, you can move up to the delegated side. But we're looking at the different, you called it, an alternative underwriting. You can see what's going on the purchase side versus the refi side on an income doctrine. If you're not providing these products, you're missing a big part of the market. And so we're going to talk on the next slide about tips. But I just think it's really important for people to understand this doesn't have to be scary. It's just really about arming your team with all of the products and setting yourself up for success. So, anyway, same theme, but just switching it a little bit, because I think this is a really important part of the market. As Randy was saying, some people, said, I'm going to put my toe in, I'm going to hope for this to be like 5 or 10% of my business. And when you really dedicate to it, it becomes 30% of your business. And it's not that the agency went away, it added, that much more volume to your business. So this is a really important part of the market. Eileen, I don't think we can hear you.
You can't hear me?
Yeah.
Now we can. Yeah, you were
Okay.
quiet.
Little blip there. But you're right. A lot of people also think that the non-QM market is a trend that is going to go away, that it was a temporary fill for something, but it's not. It's a huge part of the market. Your point about it's not going to affect your agency market, no, that's always going to be there, but you can serve a wider part of the market by offering this expansion of products. You can now serve the borrowers that you couldn't serve before because it didn't fit into that nice little box from an agency standpoint. So it's not a trend, it's here to stay, and it continues to expand.
Yeah, so Brian, this is, an important part of, what I think we're doing these webinars for, not only is to bring awareness of your products and our partners, but also how to be successful, how to grow this part of the business. And, I think these 4 points, you have to really partner with your lender or investor. They are experts, they are in your camp. You're approved with them, you lean on them and use them. And creating internal, an internal non-QM or non-agency expert is also super important. These are all really 4 important points. Obviously, we're a little bit passionate about the technology side, but pick what you think are good tips, for people to be successful, starting this or expanding it or growing it or going from dipping their toe into this being a really big part of their business.
Well, probably the first two is that's probably the 2 topics I could speak the best to, right? I'm not a tech guy, I'm not a marketing guy, but I do find those important. We can touch on those. So, your first point, partner with that lender investor, right? Someone who's new to the space, it is new to them. It could be Greek to them. There is, I think, a sense of concern that they're entering a market that is, the Wild West, and it's the furthest thing from it, right? So like I said earlier in the call, I think, you know, as a lender that lends in this space and essentially an investor in this space, right? As far as, you know, our parent and whatnot, it's important for us to really educate, to do a little bit of hand holding in the beginning, right? These are type of loans where, you know, our account managers, our AEs, right, our capital markets team, our compliance team, you're heavily involved in these loans because there's a lot of questions, there's exceptions, right? There's scenarios, right? This isn't an agency loan. So you're not in this by yourself, right? There's a reason that companies like NQM and ARC exist to help our partners, right? And I think it's something that's important as we grow because we have the experts here to deal with that. So I think it's important to partner with someone that understands a space, that gives you a comfort level with doing it, and then having someone internally, right? I mean, depending where you are in the process, whether that's someone really, I would say a lot of it's going to be in kind of your ops area, right? And underwriting any, you know, in that arena of someone that understands non-QM, right? And it could be across the board because it is different than the agency business, right? There's not, you know, nice thing about the agency business, government business, there's a script and they've given you a script. This is not really a script. People are constantly rewriting a script. So you have to kind of keep up with the trends, and you probably need someone for the most part that you can kind of rely on. I don't think you need a huge team within the organization that you can kind of, that's your, you know, your sounding board, someone that can level set you, someone that can, you know, kind of keep you in the right direction. And then, you know, the technology side, right? And I think the technology side is just moving with the market, meaning a lot of these technology partners already existed. They're expanding into the non-QM space. Whether it's a company like yours, you know, you're seeing a lot more, you know, AI type things coming into this sector. And so I think that's evolving with the market because it has to. And then the marketing reach, right? And to get to that point, you know, I think our marketing department does a great job in that. And it's just really, I think it's important to highlight these products, right? Because this is a very product-driven sector, right? Agencies are agencies, and it's kind of this, and prime jumbo is prime jumbo. But as you're changing things, whether it's in, you know, business purpose lending type arenas and DSCR or bank statement and that traditional non-QM, whether it's credit expansion, whether, you know, you're moving into other geos, whether it's, you know, whether you're going now into, you know, more of that, you know, RTLs and things. It's important as you know, bring those products on to market that, so your client base realizes, hey, ARC now offers that, right? Or they now do that. So I think it's more important in that marketing side for the non-QM, non-agency space than traditionally in the agency space.
Yeah, and I would say, sort of working from the right to the left, when we talk with retail folks, it's also about, you know, getting out in front of not just the realtors, but in those business purpose communities, organizations. It's a different kind of marketing, and getting in front of those folks, or, you know, it's just thinking a little bit differently.
Yeah, and I think in that, yeah, I'm sorry to cut you off, but just to stay on that business purpose lending side, right? This is where this, you know, the kind of that what's called the commercial broker business lending space, we start bumping. This is where you kind of start moving away from that traditional agency stuff and maybe move, and I know this is a negative word, but kind of move into that hard money area. Now, I think some of this, you know, this non-QM lending, this DSCR lending, just due to how deep it is, due to the liquidity, due to the warehouse finance, things like that, you can kind of come in, and where hard money used to serve a purpose, I think traditional lenders are now moving into that space, and what they're being able to offer is lower rates, better liquidity, right? I think, and that's what they're looking for, especially those guys serve that, you know, that business purpose lending arena. They just want constant liquidity, right? They're not as rate sensitive, to be quite honest with you. It's just that constant access to capital as they continue to build their real estate portfolios.
Yeah, and so yes, these are great areas, especially with that business purpose side. But think about, you know, as you talk with your the real estate agents that you partner with, and some of the other folks that, you know, the retail side are working together with, is really making sure that they understand. Don't feel like your self-employed borrower, or, you know, other types of borrower profiles should be afraid of moving forward. These are things that can be handled, and getting that word out, along with, you know, partnering with your investors using those resources and creating some expertise inside. And I have to give a plug for LoanNEX, a bit here. LoanNEX is a great tool for people that are not able to keep up with all the change of all these products. We sort of make it easier. I call it paint by numbers for the non-agency side. We give you all the answers all the way through the nuances of ARC's programs, the nuances of NQM's programs. So there are nuances, whether it's on acreage or whether it's on short-term rental or long-term rental or gift funds. There are a lot of nuances. You don't have to know them. You don't have to have it as a research project. Just open up LoanNEX, go through the process, and we're going to direct you through it. So it makes it a lot easier and less intimidating. But to give a quick pitch, and Eileen, I'm going to set you up for some of the success here, is the bottom part of this is really about why. Why are these kinds of programs important? How to be successful, but why? I'll let you cover off on some of these, but then we're going to quickly go through your programs and your products. But why should people care? Oh, we lost you again.
We lost you again.
Hello?
There
Yeah.
we go.
All right. I'll just lay everything I say, maybe it'll work. But I'm just going to reiterate really what I said previously is it's not a trend. It's not a market that is going to go away. You need to be a part of it to be successful and continue to grow your own business. There are plenty of materials out there to be able to get to know these products. I know from our standpoint, we do seminars on a weekly basis. We send out marketing twice a week to get the word out with the different options that are available, foreign nationals, ITINs, and so forth. And I know you're going to let me plug on my own programs, but those are just part of the entire non-QM market. Get yourself out there. Once go to realtors' offices, go to investment club meetings, do whatever you can to try to expand that. That will make everybody more successful. And you mentioned here about attracting, retaining top ML mortgage loan officers. The more tools in their toolbox, the more successful they will be. So having somebody who's limited to just an agency market is got to be tough these days. We've taken a lot of our loan officers, or some of our loan officers, from the agency market and taught them non-QM, and it's expanded their world dramatically from an AE perspective, and then working with their clients to really train them and help them expand their own business. The technology, using the bank statement analysis, using the webinars, partnering, like you said here, with your lender investor, knowing who is expert in their fields, like Brian said, NQMF, ARC, and the other people in the market. We know what we're talking about. We know exceptions. We know scenarios. We get that call every hour. I have this guy who blah, 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 blah. Like, that's just the story of the non-QM market. And the more people are aware, the better that they will be from a success standpoint, from each of these standpoints, expanding your volume, extending your margins, attracting and serving more borrowers.
So I know we are starting to wrap up, and I wanted to give you a chance. Brian, why don't you start just, to talk a little bit about where you guys are, a little bit about your products in the market.
Sure. And I won't, I'm sure this packet will go out and I don't need to read this verbatim, right? But I mean, I think what you'll find with ARC, and I won't speak for Eileen and her shop, right? We're a traditional non-QM lender. We've been doing it a while. We have, we have access to a ton of liquidity in this sector from an investor standpoint. And we're continuing to try to evolve with the market. I think it's important. This market is, nice thing about it's exciting because this market is continuing to evolve. And when I'm saying that, I don't think it's evolving to the point where we're assuming more risk, right? I think we're hitting probably more down that fairway type of borrower, right? Whether either the agencies are stepping away from certain things or just this underwrite at times could be less, less painful. And I think it's important for shops like like ARC to continue to serve, right? I don't think there's one right borrower here, right? I think that's one of the things that, you know, if you look at a non-QM borrower, it's not necessarily someone that, it's not a subprime borrower. It could be someone who owns a gas station, or it could be someone who owns a business that's generating 50 million a year in revenue, right? There is this wide range of borrowers that kind of fit this box, which is awesome, right? And it's not like, I think people think it's very niche-y as far as a borrower class. It's not, right? I think that's some of the, you know, some of the stereotypes, some of the stigmas that non-QM for some reason has a reputation. And I think it's really just a name. I would love to change the name. I think you could change the
I
name.
know, that's why I keep saying expanded.
Right. Well, I mean, if you know, whatever goes on with the
non-agency.
CFPB, right? Like, I don't know, but like, actually you could, but that's the thing. I won't go through this, but yeah, I mean, if you're looking for a partner, if you're looking for someone, I'm not just promoting ARC, but I think it's important to partner with a non-QM shop that has been doing it for a while, understands it, gives you a comfort level. It's education at the end of the day, you know, getting on calls, picking up the phone. That's why we exist. So I'll promote that. And one other thing is we do, you know, if you aren't looking for a first mortgage, we do have a home equity channel. I do think that is a trade that's going to continue to thrive in the coming years, right? We're still, you know, many basis points away for majority of our borrowers for cash out refis to make sense. So if you have any needs with home equity, I'll promote that as well.
Yes, and you can also find those products on LoanNEX too. Eileen, you want to talk a little bit about NQM's products?
Yeah, so I think the biggest thing from a relationship standpoint for us is partnership is key. We look at each of our clients as a partner and want to do what we can to provide them with all of the products so they can have them all in their toolbox and you know, and help them grow their business. So from the self-employed borrowers, we have multiple offerings from that standpoint: bank statements, P&L only 1099, WVOE, we go up to 3.5 million there. The business purpose loans, the 1 to 4, we have a 5 to 10 multi-unit and a 2 to 8 mixed use product. We have a wide variety of products available for ITIN, foreign nationals and non-permanent resident aliens. We've had a lot of webinars for that recently. Asset depletion and utilization, that continues to be a growing trend for people who have, you know, the assets, and literally that's the easiest way to qualify. You get them, you divide by whatever the particular denominator is, and you're golden. And we offer super jumbo product, 3.5 to 5. We do go up to 8. So a lot of different options there, but really non-QM funding, like ARC, has been in the business for quite some time. We are experts in our field. We have all of the bells and whistles from a technology standpoint, and really value our clients. We're here, we do scenario desk. Our exception desk is huge. We're starting to put out some of our exception percentages because not everybody's, you know, kind of cut into stone, and particularly in this market. So a lot of different exceptions even to our own guidelines. And one thing that we do is, if it's an exception that we've been approving on a regular basis, we will update our guidelines if it's something that we feel comfortable with long term. So it's something that we are constantly evolving. We're not tightening our credit box. We're fine tuning things here and there, you know, as different cohorts come up that might be more difficult to get comfortable with, but we continue to expand what we're doing to complete. We offer that NQM, non-QM offering to our clients. And I too wish it wasn't called non-QM. It's like, I always explain to everybody, here's QM and here's everything else, which is not QM, right? Like, it's just not QM. That's what it is. So it's strange. It's been going on, like, obviously for a long time, but it is part of the broader non-agency market and just more expansive.
Yep. Well, this deck will be distributed. A few people have asked that. This deck will be distributed to everybody, and it's going to be fully, you know, clickable. So if you don't want to copy and paste emails, just click on it. It's going to take you right where you need to go, along with taking you to all the information for for all of our clients, including LoanNEX. So if there's anything that you are looking to find out more about, the deck will be distributed to everybody that's participated. Feel free to, also there'll be replays of this. So if you want some of your teammates to watch it or to have access to it, feel free to extend this out. Brian, Eileen, thank you so much. Robert and I really appreciate you joining us. It is remarkable to me how much people are still looking for information about how to be successful, but that's what we're here for. You guys have been great partners to us, and we really appreciate being able to do this, but this is a really important time for people to expand their toolbox. You've given plenty of information about why it's important and about how to navigate it. Now really it's just about partnering up and doing it. So thank you very much. And I hope that you have a fabulous Memorial Day, and we'll probably see a lot of you guys up in New York.
Thank you so
And
much.
speaking of
Thank you.
which, thank you very much, guys. Speaking of which, if anyone is looking to sit down and have a discussion at the New York Secondary and you're attending, please reach out. We're more than happy to do that. And then our next webinar will be a follow-up to kind of discuss some of the trends and topics that were covered at the New York Secondary. So please don't miss that.
Yeah,
one.
and we've
It's gonna
got
be
a
pretty
great
exciting.
retail solution that can tuck right into your Encompass platform. So you don't have to change any of your agency workflows, and you can get connected with all these guys really easily in a very streamlined fashion. So reach out, talk to us, ask us about it. But that is a really slick way to be successful in this part of the market, is just tuck us right into your Encompass environment. So anyway, thank you all very much. I really appreciate it, and we will talk soon.
Thank you.